Here we go again. What is going on, ZCommunity? I have no idea if you guys can see me or not, but essentially welcome to part 3 of the live stream, where we're going to continue filtering out all of these stocks and eventually go from 21 stocks to my goal of 5 to 6 stocks. If you guys missed out on what we did in part 2 and even part 1, be sure to check out the previous playlists because I got everything pre-recorded and straight added onto the playlist. Now, before we start, I just wanted to say, if you guys are looking for key takeaways because you don't have the time to watch the entire streams and you don't want to look at it through the playlist, you should follow up our Instagram account, Azizz.finance, and essentially I put key takeaways on the Instagram account. On top of that, we did release a new podcast called The Personal Finance in Canada Show. Whatever podcasts platform you're listening from, it's on there. Just search it up and check it out. We actually release episodes every single week, so be sure to check that out and you're going to be getting a lot of value from those podcast episodes. Now, without further ado, let's actually begin with what's going on for today. Now, I'm pretty sure you guys don't see me, so let me try to first figure that out, right? Because it's the most important part of the day still. Let's see. Just give me like 2 seconds to figure this out. I know I do this all the time, but I'm just trying to see why this isn't a thing. Okay, there we go. Awesome. All right, let's get started. So, as you guys have seen, what the filters that we have actually looked at in the past, first things first was a price to earnings ratio of less than 20. We saw that a majority of these stocks actually did have that, so that was pretty easy to do. We were also looking at an EPS growth of 10% per year pre-tax over the past 10 years. And because we are not going to be looking at the post-tax, we're just going to be hiding over this column. Now again, I'm not going to go through every single thing again, so what we're going to do is we're going to dive right straight into it. So first things first, let's see what we got here in terms of the dividends. Now, if you don't know what dividends are, I also suggest going through the past videos on the channel to figure out what dividends are, because we will not have enough time to explain this on the live stream. So in order to find out what the dividend status of these stocks are, we're going to check out our best friend, macro trends. Now, macro trends, if you guys do not know, basically will show you historical data on any stock or any company that you really want. So because we're looking at dividends, let's pull up Oracle. Or you know what? Instead of using macro trends, I want to use Yahoo Finance because I feel like it's a lot more faster in terms of pulling up data. Because at the end of the day, we just want to see if these stocks are pulling up dividends or not. If they are, then that's when we'll actually go into more depth. If they're not, then we just completely put a no for 2 columns, basically killing 2 birds with 1 stone. Now, as you guys can see over here, Oracle does pay a dividend, so that does clear it in for that. Let's look into Verizon. And they're paying out a dividend, a pretty nice one at that. 4.34% for a telecom company is pretty solid. KMB. Let's see what else we got here. CPB. Okay, it seems like a majority of these companies do pay out dividends. But at the end of the day, I just want to make sure so that we don't end up wasting time. Clorox, pretty solid dividend. I also wanted to add that in as well, because a lot of people end up getting swayed by how much a dividend is. Now, I'll tell you guys this, like a little simple rule of thumb that I like to keep in mind. If the company has anything between 2 to 3%, then it's something that you can kind of rely on. But if it's an individual company and it has more than the 3%, you really need to exercise caution. The reason I'm saying that is because dividends are usually a form of... Okay, wait, sorry, Keytronic. Let me just put that down here. I'll get back to my train of thought. All right, so basically what I was saying is dividends are basically whenever the company makes profits, they split their profits in many different ways. Some companies will end up reinvesting it back into growth, whereas some companies will actually pay back the people who have invested in the company. And this type of distribution or this type of payment is what's also known as the dividend. Now, the reason why I'm saying to look out for companies that give out more than 3% is because that means chances are that it's giving a large percentage of its profits to its shareholders, which isn't always a good thing, right? Depending on the industry and depending on the company, you want that company to reinvest profits back into the business to grow the company. So that's just something I thought that you guys should keep in mind. Well, I think one exception to this is actually real estate investment trusts, also known as REITs, and master limited partnerships, also known as MLPs. Now, with these types of companies or these types of, I would say, groups of companies or whatever you'd like to call it, really, the reason why it's okay to have more than 3% is because these types of companies are legally supposed to be giving out 100% of its profits out to whoever's invested with them. Yeah, so anything if you're seeing like 5% or a 6% on a stock, and then you end up finding out that it's a REIT, then that's completely fine. But again, of course, make sure you're doing research into the actual REIT or the MLP to make sure that it is something reliable and something you want to put your hard-earned money into. And honestly, even if we have enough time by the end of this live stream, I do want to give you guys a little bit of a caveat because I've been noticing a lot of people have been getting into the stock game, but I feel like there's a big mentality that a lot of people have going into this, and I really need to clear that up big time. That's TRQ. So essentially what I'm doing right now, and I'll give you guys the update as soon as I'm done, which I need like 3 more stocks. But essentially, it looks like 3 companies so far do not give out dividends. So that, for me personally, that'll already cancel them out. Where I'm looking for companies that do give out dividends just so that it's an increased amount of return when I'm looking into these companies. Awesome. So that was the last one. As you guys know, loan. We've looked at that in part 1 and part 2. But essentially over here, we have KTCC, Vivo, TRQ. They do not give out dividends whatsoever. So because of this, along with WLKP, which we canceled out from last time, we're going to have to just completely say no to them. So we're going to be 1, 2, 3, and 4. And we're going to hide these so that we don't have to worry about them anymore. Awesome. Now let's actually start looking into the dividend growth. And this is probably one of the biggest and most important factors because we want to make sure companies are growing their dividends on a yearly basis. So let's actually look into the first one, which is which is dividend growth of over 10 years or more. And then we're going to also look at dividend growth of 20 years or more, and then fill out the sections as planned. So first things first, my boy Oracle in the cut. So whatever, I'm just going to click revenue and just kind of trickle it down from there. Okay, cool. So usually with macro trends, again, what we're trying to do over here is look at historical data for dividends that were paid out. This will show us if it's a dividend aristocrat or a dividend king. There's different categories on where these dividend paying companies fit in. But again, we're not going to be looking at this too crazy for this live stream again because we're trying to cut the fat and get straight into the meat. Wow, so it looks like, oh, okay, there we go. There usually should be more data here unless my computer's just laggy. Ah, there we go. Okay, so as you can see, it kind of gives you like a little bit of a summary here. Historical dividend payout and yield for Oracle since 2011. Now the current, okay, blah, 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 is that. Okay, cool beans, my dude. So what we're going to actually do is actually look into the all section. And this will actually tell us for how long Oracle has been paying out a dividend. Now I did press all. Ah, okay. Yeah, guys, you got to make sure when you're using macro trends, you got to make sure that you're using those filters to make sure that you're getting those like accurate data, essentially. So what we're going to do is if we're looking for something within the 20-year range, then we're going to make it at 2001. So January the 1st, 2001. Let's look into that. Please update for the mans. Or is that it? Was I supposed to press enter? Yeah, as you guys can probably see that little loady bar, I can't really tell what is going on right now, but I really hope that it loads up or something. It's kind of sus, I'm not gonna lie. Okay, in the meantime, so that we don't waste time, let's look into another company. Verizon. I'm pretty sure Verizon is probably one of those companies that has been paying dividends for a long time. In terms of growth, I would say most likely, but again, we don't want to be making assumptions. Holy guy. Yeah, my computer's bugging. Yo, I just took in the ZCommunity logo is literally interfering with my face. Let me fix that for you guys. My bad. Hold up. Because that's not cool. I'm going to put myself in the top right corner so it could... because I don't think anything is going to be in the top right corner. Let's be for real. Awesome. That should have fixed it. There we go. Verizon. Okay, historical dividend payouts since 1986. That means that Verizon is already a good one for us. So we're going to be putting in yes for both. That's amazing, actually. Wow. Well, okay, now we know that it has been paying out dividends over that period of time. I didn't even include a section for that. Wow. Okay, if that's the case, let's look at Verizon's growth of its dividend over the past 10 years and then over the past 20 years. Nah, you're joking. Okay, we're looking at dividend. Nah, we're looking at dividend payout, my guy. Okay, guys, as you can see over here, this chart, the one that's in the middle, the TTM dividend payout. Now, this is beautiful. This is exactly what you want to look for when you're looking for a dividend stock. Something that's consistently increasing its dividend over time. And it's steady. It's consistent. Look at that. It's literally a straight line, my dude. Y equals mx plus b type of vibes. That's beautiful. Okay. That already puts us at a good situation. So for Verizon, we're going to end up putting a yes in terms of dividend growth for 10 years plus. How about for 20 years now? This is going to be more interesting. Very interesting. So this still looks good, but these two little peaks, there must have been something that went down here. So as you can see, it keeps going up. We're looking at the middle chart, by the way, because this is what's actually telling us what the dividend payout was. And it seems like it's giving this to us over a quarterly period. So every 3 months. So as you can see, there's still, okay, there's an increase, and then boom. When did this happen? 2006 to 2007. And then it decreased big time in 2008. And after that, it was still on that consistent course. And then after that, boom, it zoomed all the way up in 2010 and then zoomed all the way back out in 2011. Now, I could be mistaken. I'm not 100% sure, but chances are the 2008 like financial crisis. So they likely increased that dividend to kind of tell their shareholders, yo, like, don't even worry. We got you guys. Don't stress. Like, stay with us type of thing. Stay invested with us. And I feel like the same thing over here. I think in 2011, correct me if I'm wrong, there might have been a pullback in the stock market. And I feel like that was just another incentive. But as you can see, after 2011, I know that there was a pullback in 2015-ish. And even the crisis that we just went in, the COVID pullbacks. There was nothing there. So that's what we're trying to look for, that consistency. Something that tells us, yo, no matter what the situation is, this company will still give you a dividend. So for Verizon, we're going to put a straight up yes. Hey, what's going on, my dude? Jackson. Jackson, man. Man, shout out to you, my dude. I miss you so much. But thank you. I really hope that you're gonna be taking in value from this live stream. In terms of market crash, I do see that question over there, but it's not in my place to say whether we're going to face a market crash or not. All I do have to say is be careful, and whenever you're about to buy a stock, whether that's long term or short term, be sure that you're defining your risk beforehand and you're defining your reward beforehand. If it ever does end up hitting that certain risk that you're willing to tolerate or below, just sell. Like, don't even think about it. Follow your plan all throughout. So be sure that you're really staying wary, because personally, like by looking at the market, it just looks scary. So just be careful. Anyways, we're at Kimberly Clark right now. And essentially it's been giving out a dividend for the past 31 years. Awesome. My page is unresponsive, which is also beautiful. And exact similar same thing that we kind of saw with Verizon, essentially, where you do see that consistency going on over the past 10 years. And of course, just some huge increase over here, and then a huge decrease in the 2015 2016 range, which was likely within that little pullback that we had throughout those years. But afterwards, you kind of do see that the price is consistently increasing, which for me, I'm okay with. Like this little thing over here, as I explained, it's a one-time thing. It's a very temporary thing. So for Kimberly Clark, for the past 10 years, we are going to say yes. Past 20 years, as you can see, that consistency and that increase is what we're looking for, and it's there. So Kimberly Clark is another easy yes from us. Now Campbell soup, because men's be getting corona and they need that chicken noodle soup to get them better. CPB Campbell soup. Let's see. Yo, I don't know if any of you guys ooh, that's very interesting actually. So it's actually the opposite. So instead of the dividend going up and then shrinking back down, this one was kind of rocky, and then this one actually went down and then it went back up. This is kind of hinting, okay, this is definitely when the COVID crash happened. It looks like they weren't able to sustain that dividend increase or that dividend growth. So then they faced a pullback. The dividend went essentially from 129 to 98 cents. Now from 128 to 98 cents, was it? I know it doesn't seem like much, but when you do it on the calculations, it's actually a 23% decrease. That's not a good thing whatsoever. I do understand companies were affected by COVID and whatnot, but again, we're trying to look for companies that could withstand these type of things. So for Kimberly Clark in the past 20 years, is that? No. Actually not, for both it literally doesn't qualify. Over the past 10 years and over the past 20 years, because this was recent, right? So we're going to put a no for both for Kimberly Clark, for Campbell soup. And honestly, if it wasn't for that, it would have been on the yes, but again, we got to be super picky when it comes down to putting our money, our hard-earned money, into companies or investments overall. Okay, Clorox, I see you. That's beautiful. That is beautiful. Consistent increase, no question about it. There hasn't even been a pullback in the dividend, so that's a yes and a yes from my end. A yes and a yes. Yeah, I'm just gonna copy and paste this rather than typing it all the time, because I'd be taking up a lot of time. Okay, next company, IMOS. And in the meantime, while that's loading, let's look at what Oracle was looking like. So as you can kind of tell, it's been saying that the dividend yield has been starting, the dividend payout has been starting since 2011, meaning that it's only been given out a dividend over the past 10 years. Now this kind of does suck, but you know what? I'll tell you guys something. It won't qualify in terms of the 20-year data, but it would. We'll still have a look at it for the 10-year data, just to kind of give it some sort of fair value. All right, so with Oracle, you can see that there is some increase within its dividend. it kind of does look choppy in comparison to the other companies that we have seen. And then over here, you can tell, boom, COVID thing, this thing went down, but then it quickly recovered, similar to what other companies faced. But again, because there was a decrease and they were not expecting that, to the point where they had to decrease their dividend, I'm saying it's a no-go. And I'm making this comparison with like every company that had to deal with COVID. I'll be honest with you, there was this one REIT within my portfolio that really specialized within the retail space. And as you guys know, like retail got hit super hard. Nobody can go to these places, nobody can go to these stores, whatever. And surprisingly, this REIT didn't face a dividend decrease whatsoever, and they still did pretty good. So that's basically like one of the things that I'm basing it off of. But for Oracle, we're gonna have to say a no for the 10-year data. Let's look at IMOS. Oh, only for 7 years. That's already a no-go. So that's a no and a no. Next up will be MLI. Not sure if you guys were wondering this, but I'll tell you guys anyway. The reason why we're looking for something over the past 10 years or over the past 20 years is because it gives us an indication of consistency, and it gives us an indication of how reliable it is in terms of whether this company is going to increase that dividend or not. As you can see over here, they've only been giving a dividend out since 2006. So not quite at the 20-year mark, but it does surpass the 10-year mark. So that is the only thing that we are going to look at. So let's put that there. No data for 20 and no data for 20. But for 10, you could see that there is an increase, definitely 100%. Would you say it's consistent? I don't think so. It's consistent in terms of whether or not like the dividend is increasing, because as you guys can see, there hasn't been a decrease. It's just kind of flatlined, increased, flatlined, increased, flatlined, and then increased. So you know what? It does kind of make me a little shaky, but because it is still increasing and it is basically consistent, I'm gonna have to say a yes in terms of dividend growth for MLI for the 10-year data. Now let's look into the next company, which is Hawkins. Yo, my G, Hawkins, pull up. All right. Also, guys, if you have any questions about anything that I'm discussing right now, like, just let me know. Like, I'm more than happy to clarify things out for you. All right, Hawkins has been giving out a dividend since 1997. That's some good news. And as you can see, that consistency is there. That increase also there. Yeah, sure, there was a little decrease over here, but again, because of the same factors that we talked about when it comes down to market pullbacks and how companies can actually face situations that we don't really want them to face, but by them actually increasing that dividend kind of gives you confidence that, okay, this company can handle it. So in terms of the 20-year, which is probably going to look the exact same as the 10-year, yeah, Hawkins fits both of our criteria in terms of the dividend growth. Shout out to my guy Hawkins. Next up is DIT. Yeah, this was the one that gave us problems before when I was trying to pull it up on Yahoo Finance. So for that, I'm just going to put a dash. Sorry, it gave us trouble when we were trying to pull it up on Macro Trends, not Yahoo Finance. It pulled up on Yahoo Finance just fine. Speaking of that, let's try to figure that out. DIT, Amcon. So why is it not pulling up? We could look into that after so that we don't waste time. In the meantime, let's go for RGR. Okay. Now in the meantime, while you're being super slow, let me pull up this other one. Okay, MEI in the meantime while this bad boy's pulling up. Nice. Come on, man. Yo, I can pinky promise you guys, it's not even my internet. My internet's actually popping. It's literally just this laptop. I think it's just going through a lot right now, so keep it in your prayers, yo. Still better than what I had before, man. I had like some Windows 7 laptop before, and it's like every single time I would turn that on, it would just start breathing heavily, and it was just a bad situation. Oh, yikes. All right, guys. So RGR has actually been given out a dividend since 1992, but you can already look at this chart, and you basically, if you didn't get anxiety, then like I don't know what how you were feeling, but this is not good. This is not good at all. And there's a huge inconsistency over here, as you can see by there's no dots in between that huge line, which means it didn't pay out a dividend for a certain amount of time. So from 0.25, boom. So that was 2009, between 2009 2005. Not a good sign whatsoever. RGR out of the picture, no question. MNDO. I'm not even going to look at the 10-year because the 20-year didn't even look nice. Okay, whoa. MEI. Not looking good at all. Yikes. I don't know what happened over here in 2002, but it's basically... Okay, MEI is basically on the same boat where it's basically one of those 1999ers. It has been given out a dividend since 92. In 2002, I don't know what happened over here. $7.72 of a dividend, and then crashed all the way down at 0.14 cents. Yeah, there's a dividend increase, but it's not really substantial. I don't like that. Let's try to see if we can put this from the 2002. So July the 7th, sorry, July 11th. Let me put that in. Because by doing this, I'm going to try to narrow it down to see if we could take out that outlier. 7/11/2002. 7/11/2002 till today. That would basically be, what, 19 years? Yeah, even then, it's not really looking that nice. Or maybe we have to filter out one more outlier. 10/10/2002. 10/10/2002. See, that looks a lot better, right? But then the problem that we're facing here is that it's 19 years. It's 19 years. It's not really a... Like, okay, here's what I'm going to do. Because we're looking at the 10-year... Okay, let's look at the 10-year chart. The 10-year chart also is facing somewhat of what we've seen before, where it's like kind of plateau, increase, plateau, increase. So what we're going to do for the 10-year, because to be fair, it hasn't really decreased. I'm going to put a yes for the 10-year growth, but for the 20-year growth, I'm going to have to say a no. And I'm pretty sure you guys can understand where I'm coming from on this side. If you don't, let me know in the comments and I'll clarify that for you, no problems. CRWS, Crown Crafts. And this one we pulled out was MNDO. So MNDO dividend, hasn't been given out a dividend since 2005. So it already doesn't... Okay. Been given out a dividend since 2005. That's definitely not 20 years, and it's in the 10-year range. So that's a no for 20 years. And for 10 years, I don't like that. I don't like the fact how it went down from like the 2011 years. I don't even like the fact how it's not even showing us that 2011 data. Yeah. So as you can see, this company does give out a dividend once every year. Now, usually companies give out dividends on a quarterly basis, but for some reason, this one actually gives it out once every year, which is still pretty good, but at the same time, considering its low dividend, I don't really think it's worth it. How much does this cost? It's about $2.98. Okay. For this one, we might actually have to pull out its actual technicals. I'm not really that sick when it comes down to technical analysis, which is basically you going to you basically basing something off of a chart. But I just want to get an idea of how its performance has been going on the long term. It's just been flat. Yeah. As you can see, it's kind of been averaging around, what, This area, the 2.5100, and it hasn't really been doing anything since 2000s. I already don't like it, and it's such a high dividend yield too. That is not a good sign whatsoever. So you know what? For MEI, we're just gonna completely disregard it. It's not really nice. Or sorry, not MEI. I'm not trying to confuse you guys. MNDO. MNDO is a no. MNDO is a no from both angles. That's it. And in the meantime, we'll look up at CRWS while this one is popping up. CRWS. So it's been paying the dividends since 2012. It doesn't qualify it for the 20 years, but it does qualify it for the 10 years. Now looking at this, if we're looking at from the 2011s all the way till now, this is not good. We have one huge hump that came out of nowhere, another huge hump that came out of nowhere, and then it literally kind of went to the same levels where it was at before, and then a huge another hump, and then it kind of just, there's no inconsistency. Yes, it's growing, but the inconsistency, like, it's just not there. So for this, I'm gonna have to say a no for CRWS. And yeah, that's for both angles. EBF should be this other one. Let me just make sure. Nah, DVD. Guys, did we check out EBS? I'm not gonna pull it up again, but guys, let me know if we did pull up EBF or not. EBF ticker symbol. If we did not look at that yet, let me know in the comments. But if we did look at that, also let me know in the comments, because I don't think I even wrote anything here. In the meantime, let's look at DVD. DVD since 1999, not bad. Over the 10 years, we have been facing some increase. Obviously, there's no consistency, but in the 10 years, I'll give it a yeah. In the 20 years, oh, I'm giving that a straight up no. Yeah, I don't even have to explain myself for this one, guys. You could already look at the chart, and it's just not a good situation. NPK. National Presto. Yeah, that's the company that makes my Presto card, right? Just joking. That's not the company. Loan. Manhattan Bridge Capital. That's going to be an interesting one. NPK. All right. So it's been giving out a dividend since 1990s. Nice. 20-year chart has been going up. That is a good sign. It's increasing. There is consistency. It's just when it came down to that this area, which she was from between 2011 to 2015 before it started going up again. This is when there was a lot of financial uncertainty within the markets. I'm not sure why it took them a really long time to recover. It's not really a good sign. Interesting. So 20-year, I'm not even gonna qualify that. For the 10-year, I'm also not gonna qualify that either, because how are you gonna go up all the way there to 622 and then go, yeah. And plus, as you guys can see, whenever I move my cursor on this middle chart, you can also see that the bottom chart's moving along with me. And as we said before, if a company is having a dividend yield of more than 3%, that's already a red flag. And as you guys can see over here, 14.16%, 5.7%, like the numbers are just way too high over here, and that's not something that I can really have a lot of confidence in when investing in a company. So for NPK or National Prestos Industries, both of them are getting a straight up no. No and a no. I wonder what loan is going to look like. Or Manhattan Bridge Capital. Oh, what was going on there? Apparently it's been given out a dividend since 2005, which already doesn't make it qualify for the 20-year. So that's already a no. In the past 10 years, I don't know what was going on here. Look at here, between 2005, it didn't give out a dividend until 2013 again. But you know what I do like about this? Or wait, whoa, never mind. Yeah, nah, the dividend yield is high. It is still given that increase in dividends, but let me see. So as you guys can see, there is that increase, there is that consistency, but the problem that I have with this stock is the dividend yield is way too high. Like, unless it's a REIT or an MLP, then like by all means, but even then, like at 7% yields, 12% yields, 9% yields, even for a REIT or an MLP, that's way too high still. Let's look at Yahoo Finance and see exactly what this company is all about. I feel like that'll really clear things up for us. Usually you could pull this up by looking at their profile tab on Yahoo Finance. It'll tell you like a brief little intro on what this thing is. Okay, so it's a real estate finance company that originates, services, and manages a portfolio of first mortgage loans in the United States. Short term, okay, so it's a loaning company essentially. Okay, I can see why the dividend yield is so high, but even then it's just too high for my liking. So I'm sorry, Manhattan Bridge Capital, but you're not catching it. As you guys can see over here, we have the updated, oh my goodness. We've got the updated list over here. Now I do want to make it conditional formatting over here as well, just so that we can understand what is good and what isn't good. Conditional formatting, and then we'll say text contains yes. Dude, what's wrong with that? Sorry, let me just do some formatting over here to make sure that everything that says that is dope. Alright, new rule. Cancel, add another rule. Yo, this low-key might just be an Excel tutorial still. Okay, apply to range. Select the data range. We'll go from here. Yeah, I think that's how you do it. There we go. Okay, and then if the text contains a YES. Done. Doing that will basically highlight everything that has a yes on it to be highlighted in green. Although, okay, there you go. That better work. Like, don't even cheese me. Okay, now that we're done with the looking at the dividends and stuff, I want to see if there's anything else for dividends just to get it out of the way. Nothing. Okay, cool. So as you can see, we can move over to the PE ratios, which I feel like will be really interesting. Because in part 2, we looked at whether or not the price to earnings ratio was less than 20. Turns out all of the companies were fitting that criteria. Now, what we're going to be looking at next is the average P/E ratio over the past 1 year. How is that looking like? Usually when it comes down to that, let me just pull it up. I have literally all of my decision criteria written down where it's literally in full details. So essentially what we're going to be trying to look at over here, we're going to take the average P/E ratio over the past 1 year. And what we're going to try to look for if it's still under 20. If it is, then you're going to see that the highlighted column that we have is going to be a yes. If it doesn't, it's going to have a no. Similarly to the average P/E ratio over the past 10 years. But instead of trying to like get under 20, we're going to try to get a P/E ratio average of less than 25. If it's under 25, you're going to see a yes under this column. If it's not, you're going to see a no. So without further ado, let's check it out. So yeah, first things first. What was it again? Oracle. Obviously, we're not going to be looking at that, so other ratios, price ratios will likely be there. P/E ratio, dope. Okay, so we were trying to see over the past 10 years, and we were trying to get an average based on that. So let's look at the first year. Take an average based on that. So here we have the stock price, here we have the P/E ratio, and then here we have the net EPS. But what we're going to try to look for over here is just take the average of this over the past quarter. So 430, 228. So over the past year, man, dude, why are you making this so hard? LOL. 21, 21, 20, 20, 20, and 20. All right, so let's pull out our calculator real quick. Or actually, yo, why am I still living in 2020? We're in 2021 now. Let me use my spreadsheet out here. All right. I'm gonna show you guys how I'm doing this. I'll show you guys how I'm gonna do this for the first time, and then after that, you guys can know and have faith in me that I'm gonna be doing this right the next. So what we're gonna be doing is we're gonna be doing the same thing that from part 2, and we're gonna be inputting data here, and then don't even ask me what's going on. True. Okay, I know what's going on. Oh my goodness. Yeah, insert 12 above. Why not? Let's be a little extreme here. And then bang. And then boom. Man, this is coming out from the ETFs that we were looking at before, but we're already done with that. We've already distinguished we're not going to be looking at those. All right. So you know what? Over the past 12 months, aka the past 1 year. So let's just make the assumption that whatever, 1, 2, 3, 4. So we're not actually going to be looking at the years. We're just going to be using them as data points because the way that P to E ratios are reported sometimes is just weird. Bang, and then just so that you guys and myself don't get confused. P to E ratio, growth. We're not going to be looking at growth, right? Yeah, no. We're just going to be looking at the average. And we'll do the average calculation after, actually, because the average looks at... Well, I don't have to explain average to you guys, do I? Alright, so basically what I'm going to do, I'm just going to enter the data points that we have over here. I really do hope that they do have a table that we can look at. Okay, there we go. So let's take the second most recent P to E ratio, which is at 228, and then we're going to track it back to last February. So the first one that we have over here was 1533, 1735, 1772, 1707, and 1523. Taking the average of that, we have here's the thing, right? So just by looking at these data points on the table without even having to calculate what the average is, you can already tell what it is as long as it's kind of consistent in a way. So what I mean by that is, for example, I'm saying this so that it'll save myself time and it'll save you guys time if you decide to use this as one of your factors. But see over here how we're looking at 1533, 1735, blah blah blah, this that, and up to here. All of these data points are already below 20, so you can already deduce, or you can already assume that the average is also going to be below 20. It wouldn't make sense for it not to be. So I did calculate it anyways, and I'll show you guys over here. Wrote down the data points, calculated the average, and there you have it. It's at less than 20. Man, I gotta learn how to English out here, but yeah, we got that down. Let's look at the next company, which is going to be Verizon. Or actually, no, let's look at the 10-year. No, I lied. Let's look at Verizon because the 10-year will take us a little bit longer in time, and we want to make this a short live, relatively speaking, but knowing me, it's going to probably be a long one. Or like the same duration as last time if you guys were tuned in on that. Okay, bang. So, okay, if we're looking at the most recent one from March. So 1, 2, 3, 4, 5. All under 20, so Verizon is actually good to go. That's really surprising to me because I always thought, because Verizon was like one of America's top telecom companies and the price was just a little bit relatively expensive. I thought that it was just going to be overvalued, but it seems that its price to earnings ratio is pretty solid, and it has been pretty solid over the past couple of times. Now, Kimberly-Clark, this is where we're actually going to have to do the calculation because as you can see, from March, of this year to March of last year, there has been an outlier, and that's something that we really need to sort out so that we make sure that our analysis is 100%. So let me put in the data points over here. 2111, 1856, and last but not least 1809. Ooh, super close. So Verizon actually gave me a average 1 year of 19.612, meaning, or sorry, Kimberly Clark gave me that average, which means that they still fit under that criteria, but just by a thin thread. So Kimberly Clark was really lucky on that one. Let's pull up Campbell Soup, CPB. And in the meantime, while that pulls up, oh, okay, now it's deciding to go fast. That's cute. Okay, we're going way too far back. All right. So as you can see, looking at the January of 2021 and looking back at that beforehand, you could already tell it's been below 18, or sorry, it's been below 20, 100%. No need to make calculations there. Clorox. This one I feel like is definitely going to be a little bit over by a bit, yeah. Alright, see, by looking at this now, you can already tell that the P to E, or average over the past year, has been more than 20. It's just obvious by looking at it, right? So, bang, and then... I want to make a little note for myself here too. Give me a second. I basically just made myself a note so that we don't confuse ourselves. Hold up. All right, yeah, sorry. I was just making a little note on I was making a note on the watch list so that when we review it and actually try to filter things down, we don't end up getting confusing. And now I'm actually going to end up putting the data points over here for Clorox to see what that PDE ratio is looking like. But, oh, sorry, we already distinguished that it was going to be a no. Lesson of the day, do not multitask. Next up is IMOS. Okay, IMOS. You could already tell, looking at the data points, less than 20, no question is asked. Wait, that's actually kind of weird though. The fact how they haven't really reported any PDEs. So 2019 was solid, 2018 was solid in terms of data points. 2021 and then 2020, they only reported the PDE ratio once. Could that be because it's been negative? So we said only once in 2020 and 2021. So let's look at it in the past 2 years then. 2020, 2019. Yeah, that's not good. That's a little bit sketchy. Yeah, that is a pretty sketchy situation we got over there. Yeah, I already don't trust it. IMOS is getting a no from my end. We definitely could do more research into it, but again, as of right now, it is definitely not worth it because we still have to filter through a bunch of different stocks, and then if we don't even know if IMOS is going to be 100% that pick or not, so it's no point in us actually spending our time doing that. This is actually MLI right now, and as you could see by looking at the past data points, well, like you could tell, like it's under 20, right? No questions asked about that one. So let's look into Hawkins next. I low-key feel like Hawkins is gonna pull through. I feel like Hawkins is gonna be one of those sick ones, like those undervalued ones. Like, you know what I'm talking about, right? Boom, under 20 as well. That's golden. What else do we got? DIT. Oh wait, DIT isn't on macro trends. I have no idea why that's the case, really. Maybe it could be a good reason. RGR. RGR. Alright, is it under 20? Looking at the data points, yeah, we're gonna have to make some calculations here. Not a good thing at all. Well, it could be, could not be. Who knows? We're gonna have to calculate it. So we're gonna be going from December to December of last year. So 1266, 1593, 2643, 2392, and last but not least 2357. So we've got an average PDE ratio of actually more than 20 just by a bit. 20.50, which already classifies RGR as a no under our decision criteria. Also, I wanted to tell you guys something too. I used to actually have this mentality way back in the day when I first started investing, but don't base your decision criteria only off of the PDE ratio. The reason I say this is because of the way that the PDE ratio is calculated and the way that some companies will actually go through this calculation. Essentially, how it's really done. I'm not even going to explain it too in depth, but long story short of what I'm trying to say, companies will usually play around with their accounting and their financials to make it look like they have a higher EPS and sometimes a higher stock price. So long story short, there's a lot of playing around that goes within the financials, and at the end of the day, that's why you don't want to base your decisions off of just one specific factor. You don't want to do that. You would be putting yourself in a dangerous situation, and yeah, not a thing. Also, just to let you guys know, over the past few stocks, they have been a yes. We looked at the average data, and the average data has shown to us, similarly to here, that it has evidently been lower than 20 of a PE ratio. Now, next up, we only have about 3 more stocks left, and then that's it. We can move over to the next factor. DVD Dover Motorsports. Motorsport skirt? Oh, yikes. Okay. I know that this has actually been, like, we could tell that the average has been less than 20, right? But here's a problem, and that problem is something that I cannot let slide. In 2020, EPS was a negative, and that didn't really fit in with that. And just because of that, the PDE ratio is automatically a 0 because of that. So the way that I see it, yeah, DVD could have actually passed this, but because of that negative amount, we're gonna have to put a straight up no. Because at the end of the day, right, this is also telling us what the earnings is, and if the earnings is decreasing at one point, that's a sharp decrease. We've talked about this in part 2, and check it out if you'd like, but not something that we can really tolerate in our search. So National Presto, and then after that it's going to be Loan. Okay, NPK is looking okay. To 12. Well, I think we're still going to have to take a look into it because of that 30 and the 23. It might skew things a little bit. Ooh, okay. It's a good thing I did that. It was actually average PD ratio of 19.32. It still fits our criteria, but that's why it's always good to check when the numbers don't really add up on the table. And last but not least, Loan. Then after that, we could actually look into our next factor. Okay. Yeah, PD ratio under 20. No questions asked. Bang. Easy money. Alright, so now we're actually going to look at the average over the past 10 years. And because we are already here, then we might as well just start from Loan and then go back up. Now, the question is there enough data for the past 10 years? As we can probably see, definitely there. From 2011 of, what is that? Of March. So March 2011. Oh, that's going to be a lot of data points. Got to make some room into our watch list then to calculate that all. Boom, and then we're going to pull off one of these. Even then, I don't even think that's going to be enough data points, but you know what? Let's check it out. 2011, we said March 2011, right? So we're going to bring that down here and then start inputting those numbers. 1151, 1266, 978. Yeah, most of this is gonna be just inputting data. Oh, yikes. Yeah, most of this is just gonna be inputting data. So, yeah, I'm low-key feeling like I should just put some music, some elevator music on and just enjoy me typing in data. Well, you guys can't even see that, but like, I'm doing it. 7.35. Also, guys, I wanted to mention something real quick. So, some people have brought it to my attention that they're like, wait, Tamer, like, why haven't you posted any actual, like, educational videos recently? And I'm like, you know what? We're posting these lives once every week. And I'll be completely honest with you guys, I am trying to change up the structure of how we currently make videos. I feel like there's a lot of improvements to be made, and it's just, I'm just like going back to the drawing board essentially. Plus, what I'm doing right now in terms of like picking new stocks to actually put into my watch list has been something that has been on my mind and on my watch list for the past couple of weeks now. I just haven't got the chance to look into it, and I thought it was the perfect opportunity. You know, I'm like, you know what, instead of doing this by myself and, you know, just being someone who's greedy at the end of the day, why not share this with the Z community and see what value they can also take out of this as well, right? So yeah, but long story short, there will be new content coming out soon, and it's going to be content that you guys will definitely like and get value off of. So stay tuned for that. If we don't have to do a part 4 for this, then you guys will be seeing that coming soon. Oh, whoa, I'm a little lost here. Okay, 937, and then after 937, 863. 863, 901, 842, 993. Yo, I low-key wish that there was somebody else on the other side of this, on the live, that was down to do this for another stock while I'm doing one stock type of thing, to be a little bit more on the efficient side of things. But it is what it is, right? 1221, 1290, and then 1087. Awesome. Just a couple more data points. We're almost there. 973, 1099, 11.53, 1208. Some of you guys might think that this is super tedious, that we have to do this for so many different stocks, but at the end of the day, we're just trying to make sure that the money that I worked hard for doesn't go to waste and I don't end up losing that money, right? You don't have to do this, but at the end of the day, you're basically just gambling your money away. And if you're okay with that, by all means, do what you gotta do. But for me, number one rule of making money is to not lose it. Shout out to my guy Warren Buffett still. 11.63, 13.32, 913. Oh, that's it. Okay. Wow. That was 41 data points. Not bad. So now let's actually calculate the average. We said that was at which cell? At 67. Okay, so as you guys can see, for loan, the average PDE ratio was at 9.80. Let's round that bad boy up. There ain't nobody trying to look at that number. So 9.8. It fits our criteria over the past 10 years. So you know what? Loan is catching that, yes, from our side. Now that was a pretty good bonus. Again, we do know for DIT is not a thing. Now, let's actually start from Oracle again and then go all the way back down. Boom. Okay, data entry time. Let's do this. Oh man, guys, honestly, let me know if you guys want me to do these calculations and data entry in front of you, or if you would rather me just do this on my own time and we go into another factor. Let me know. I see some of you guys are watching right now, so let me know what you guys think, and we could easily switch course and go into another factor. I want to take your opinions on that, because if you guys know what I'm basically doing, then why not go over to the next factor? So let me know in the comments what you guys think of that. Yeah, don't mind me, guys. I'm just data entrying away. You know what? I'm not trying to be a procrastinator, but I feel like I might just move over to another factor and then do the rest of these on my own time, because it is a pretty time-intensive task. Let me just finish this up for Oracle, and then we can make an update and then maybe move on to the next one. I think it might be a more better use of everybody's time. 18.10, 18.99, 19.4, 20.74. 19.95, 19.95, 58.77, 50.70, 50.08, 45.83, 18, 16.25. Now this should actually align with the other data that we had before. If it doesn't, then there must have been some sort of discrepancy with calculating this in terms of like when the company reported it and stuff. But let's just see. 17.35, and then last but not least 50.33. Yep, data points matched exactly. Oh, okay. This is why it's important to do this stuff, because check this out. I want to show you guys my screen. Boom. Turns out the average was actually just below that 20 range. And for what the decision criteria was over the past 10 years, should actually be below 25. So it still fits our decision criteria regardless. We're going to put a yes for there. But because we do want to actually save our time, let's look into a next factor. So I'm going to highlight this in yellow just so that I know I'm going to come back to it later. And in the meantime, what do we have here? Consistent revenue growth over the last 10 years. This is going to be a super easy thing to look at, because we're just going to be looking at a graph and then be like, okay, well, this is consistent growth, or this isn't consistent revenue growth. So let's check that out. Let me just pull up here. Okay, awesome. Now, because we're already on Oracle, let's pull up the actual page where we can track the revenues. So as you can tell, revenue and profits, right? Revenue, super basic to follow. And we're looking at it over the past 10 years. So we have to look at the 2021. Or sorry, the 2001 is what we're trying to look for. But for what reason? Did Oracle only come out? Oracle did not go public in 2016. Oracle IPO date. Or sorry, it did not go public. Yeah, so I don't understand. Because if it IPO'd in 1986, how come it's only pulling up data from 2006? That's really weird to me. Oh man, I'm actually a waste man. I'm thinking 20 years, but it's really 10 years. So we're only looking at data from 2011. Like, who cares about the other stuff? Yeah, I don't know what's wrong with me. My bad, guys. It's 2011 and 01. Should make it like the exact 10-year mark. Perfect. Okay. Quarterly revenues trailing for the past 12 months and then year over year quarterly growth. I'd rather just look at annual, to be honest. I don't want to really look at the quarterlies. I don't really care that much. Let's try to check out financials because that thing won't show me that. Okay, annual report's perfect. Awesome. That's beautiful. Show me the last 10 years. Thank you very much. So looking at this, we do see that there's growth, right? Is it consistent? I don't think so. There isn't any consistency there. So you could see 2011, it actually was super low. 2012 and 13 went back high, but it was kind of flatlined. Same thing with the next 2 years and the next 2 years and the next two. Maybe if like what I'm trying to look for over here is not this. I'll show you guys an example. Maybe we could look at another company, but for Oracle, we could already say as of right now, no consistent revenue growth over the past 10 years. Next up is Verizon. Chances are I just have a very nice and strong feeling Verizon and Hawkins are pretty solid, but we don't want to make any crazy assumptions or base them off that. Boom. Verizon. From 2011 to 2015, that is perfect. That is what I'm trying to look for within a company. But again, you see in 2016 and 2017, there was a very crazy flat line. This was likely because of the pullback from the market crash, or not a market crash, but like the market pullback that happened in 2015 or 2016ish, if you'd like to call it. It is kind of shaky. Yeah, it is kind of shaky. Yeah, sure, it recovered in 2018, but then in 2019, 2020, with all of the COVID stuff, it still went down. Man, that's a tough one. Consistent revenue growth. I'm gonna have to say no. I'm sorry. If you're not able to withstand certain events as such, plus you're a phone company and an internet company. If you weren't able to kind of capitalize on COVID, that's a little bit shaky for a telecom company. So we're gonna have to put a no and be very strict on that. Kimberly Clark, absolutely disgusting. Like no dissing to Kimberly Clark, but you're not growing revenue whatsoever. If anything, you might be in a little bit of trouble. That was a real quick one. I didn't even have to dive into that one. Campbell Soup. From 2000, I'm very curious about this one. No revenue growth over there. Well, this one is actually, we're flying by these ones. That's a thing about macro trends that I just discovered recently. If you don't see a specific thing, or you just want to compare the historical balance sheet, you could literally just hover over this chart, and then you can literally see chart data, no problems. Clorox, beautiful. That's what we're trying to look for. That is beautiful. Clorox catches it. Clorox gets the yes from me. IMOS. No, IMOS is not a good one. Where we can't go with IMOS. MLI is next. And in the meantime, I'll update the sheet. So no for IMOS. And I can already tell by my eyes scanning the revenues, it's probably not going to be a good one, but let's double check. Yeah, no consistency there. Hawkins. Yo, I have a feeling Hawkins is going to make it. Like my gut feeling tells me that even its revenue is going to be strong as well, but let's just double check again. Ooh. Yo, guys, oh my goodness. Hawkins actually might win this. Or Hawkins will, I have a feeling Hawkins will make it into the top 5 or the top 6, to be honest. This is dope. DIT, what's the point? It's not going to pull up. RGR. And honestly, because I'm not going to make any rash decisions right now. RGR, revenue. No consistency. Next, MEI. Boom. MEI. Ooh, not bad in terms of consistent revenue growth. I like that. I'm a fan of that. I'm gonna be putting MEI as a yes. The other two from before is definitely gonna be a no. MNDO is gonna be up next. MNDO. Okay, I'm really excited about this. I feel like we're gonna be getting a lot. Boom. MNDO. Terrible. No. I'm not doing that. EBF. MNDO is a no. EBF is a yes. Just kidding. Let's see. It had potential. It still has potential, because again, it's probably something within that pullback that we had within the market, and it tried to get back up, and then ever since 2017, it's just kind of been pulling back its slack. But again, if you don't have that consistent track record over the past 10 years, I can't trust you. I'm sorry, EBF, but you're gonna have to be a no. CRWS is up next. Crown Crafts. All right, revenue for CRWS. No. Straight no. No consistency. Next up, DVD. Bro, if you have a DVD still at home, you get my ultimate ratings. Yo, DVD's a no. I know that was really random, but like, ever since we've been doing part 1, I've just been looking at the DVD sticker symbol, and I'm like, I wonder what happened to those. NPK is a no-go. And loan might actually be one that has consistent revenues, considering the fact that they lend out money, right? But let's see. Oh, I guess not. Oh, never mind. That's some strong revenue growth. And that's consistent too. Look at that. That's dope. Obviously, there seems to be some sort of flat line at the $7 million mark, right? From 2018. And 2019 was good. There was still a little bit of a... There was definitely a slow growth rate. And then after that, 2020 it kind of flatlined. We'll put a yes for now because they still do see that consistency going on. But again, something we do have to look out for, just in case. Awesome. Cool. So we got that factor down, we got this factor down, we got that factor down. Now the thing that we're missing now is PE times PB ratio. Is it less than 22.5 or no? Now this I might have low-key kind of messed up a little bit because I did not write down the ratios of these bad boys. What we can do actually, I wrote down the price to book, right? Awesome. Okay, what we can do is actually this. Check this out. I'll make it a lot easier for all of us. So what we'll do, I'll insert one column to the right, and I'll make it PE ratio and a PB ratio. I'll insert another column for that. And then based on these two, what we're gonna do is this times that, put it in a bracket. Or wait, no, we don't need to put it in a bracket. Put it in a bracket and then actually format this conditionally. We're gonna say if it's less than 25, highlight it green. If it's more than 25, don't highlight it at all. Apply to that range. Okay, cool. If it is greater than or equal to, no. If it is less than or equal to 22.5, and I'll put a 22.50 as well. Awesome. Okay, let's get going with this one. This one should be a fast one because we're just gonna be using Yahoo Finance and then be just like sorry, let me just speak English again. What we're gonna do is we're gonna go on Yahoo Finance. We're gonna quickly zoom through each and every single one of them, put in the P to B ratios, put in the P to E ratios, and then we'll literally see that the column that we're looking at is getting filled out right away. So we don't even have to do that calculation. Excel is doing it for us and it's blessing the mans, right? So let's do that. Okay, boom. Oracle. Hold up. Let me just figure this out. Okay, statistics should be under statistics, right? So we got the price to book, and then we also have the P to E. The forward P to E. Now we're looking at the P to E. I don't think that's the forward that I'm looking for, but you know what? Whatever. Price to book 24.66, and I'll go in literally in stock order, rather than having to go back to summary and all that type of stuff. Not something we're trying to do. 3.36 for Verizon. KMB, sorry. $86.91. Yikes. Yeah, I would low-key use my phone right now to like make this a more faster process. But whatever, it is what it is. I want to show you guys what I'm doing while I'm doing it, or else I might as well just be doing this by myself. Give me a second. CLX. We've got CLX going for a price to book of 30.54. In case you guys don't know where I'm getting this from, it's literally at the very bottom here when I pull it up. Price to book from the most recent quarter. IMOS 0.06. Not interesting. I'll put it at that. What else? MLI. MLI 3.05. So next, Hawkins. I feel like Hawkins is not gonna just bless my life. I feel like it's gonna bless your life too. Hawkins at 2.72. DIT. I don't know why DIT doesn't show on macro trends. That still bothers me. What I was gonna say before about DIT, in case you were wondering, I was just gonna think of canceling it out of the watch list entirely, because if it's not pulling up data for one of the most important things that you need to look at for when you're analyzing a stock, then is it really worth considering? And that's what I was gonna be like, you know what, I'm just gonna take it out of the watch list right now. But again, I didn't want to give it benefit of the doubt. And maybe it could be a potential one that's in our top 5 or top 6. So for the meantime, we're going to keep it. We're still going to be putting information for it. But don't put all of your bets on it, is what I'm trying to say. And that's the mindset that I'm having in on it as well. MNDO with the price to book of 2.58. Yeah. EBF. Price to book of 1.79. Some of you guys might be wondering, Tamer, like, what's the point of you putting in the P to B ratio if it's already less than 1.5 and you know that? It's because it could be less, like the P to E ratio could end up balancing that out, and it could end up being less than 22.5. So it's definitely worth doing this work, even though it might not seem like it's worth it, or it might seem tedious to you. But the more filters that we apply to these stocks, the more likely that we're putting ourselves in a good situation rather than a bad situation or gambling situation. That's what they call it. That's what I like to call it, is speculation or speculative investing. That's the last thing you want to do. It's literally the equivalent of buying a lottery ticket and thinking you're gonna end up winning the lotto. Like, what are the chances of that? 1.93. And last but not least, my boy Loan from the Manhattan Bridge. Price to book 1.83. See, they're not bad. Price to books are relatively doing okay. Yeah, but we were just trying to look for less than 1.5. It's whatever. Let's try to figure out what that PD ratio is. 14.1 for Loan. What the? Okay. So I just didn't automatically apply when I tried to put in the PDE ratio, but like I fixed it. Like, we're blessed. Oracle. PDE 18.4 or 18.14, sorry. Yikes. Verizon 12.67. Kimberly Clark, KMB, come on, Kimberly Clark, where you at? 19.99. So just to give you, just to give you guys an update on how the watch list is going right now, not really looking good for that last factor that we were looking at. It seems that none of them so far have actually qualified for that one thing, which is PDE times P to B being less than 22.5. But you know what? It's worth a try. Okay, IMOS is up next. Yeah, if you guys actually looked at what these numbers were, you'd be all over the place. You'd be like, whoa, I was not expecting that big of a price. We got IMOS actually. IMOS is actually the first stock that actually has less than a multiplier of that, which is a pretty good thing, and actually it's not bad. MLI. PDE is 14.9. Yeah, no, not MLI. Hawken. It's my dude. Boom. PDE 19.39. I don't know why I paused there. Yeah, Hawkins didn't make it for that, unfortunately. Sad times. $8.29. Ooh. DIT also under. Uh, 12.76. Okay, you know what, guys? I'm actually super hyped. It looks like we might actually finish on time, aside from the revenue that we were looking at before. But you know what? I'm still open to going through that with you guys and maybe breaking it down some more. We're almost there. I think we need like about just a couple of stocks left. Yeah, we need 4 more left. EBF. And then after EBF, we need 3 more. PD 22.36. Where's my mouse? CRWS 10.55. Ooh. Okay, CRWS actually fit that. That's the third stock to actually fit that criteria. And it didn't have a P to B ratio of less than 1.5 the last time we checked. Or did it? It did actually. Oh wow, I didn't even take that in. It's a beanstalk movement from my end. 10.98. And that actually hit it too. But that actually did have a PB of more than 1.5. And last but not least, we got loan with a P to E ratio of 14.01. Boom. Alright, so what do we have over here? We have modification that I need to make to the watch list, and then we got that. So check out the modifications to the watch list. So based on the factor that we were just looking at right now, which is less than 22.5 when you multiply the price to earnings ratio by the price to book ratio. So you can see the only stocks that actually qualified for this are IMOS, DIT, CRWS, and then DVD. As you can see over here, we've actually filled out our entire spreadsheet of our watch list, except for two things. Two things or one thing? Just one thing. And that's the average PDE over the past 10 years. So I'll tell you guys what we can do. In the meantime, because I don't want to go through this repetitive process with you again, I'll do the average PDE ratio stuff on my own time. Don't even worry about that. But we are going to have one final live session, which will likely be, like 15 minutes maximum. And what we're going to be doing in that part 4 is actually breaking it down and being like, okay, this stock is good, we're going to keep it. This stock is bad, we're not going to keep it. And that's basically what we're going to do. That's basically what we are going to do for part 4 of the live session. If you guys do have any questions, you know what to do. Leave me a comment in the description below. Shoot me a DM on Instagram. Make sure that you're getting caught up on those key takeaways. Also, be sure that you are listening to the podcast, the Personal Finance in Canada show. Basically talking about some high valuable stuff for us Canadians to be aware of and for us to kind of get in control of our finances, essentially. Again, if you guys did find value from this specific live, be sure you're subscribed to the channel, you're liking the video, and you're leaving a comment of either some feedback, some good things, or even some bad things. Really appreciate it, ZCommunity. If anything, I'll see you guys in part 4 of the live. This is TAMER Azizz signing out. Peace.